How are you? Enzo DiCostanzo, clinical professor of economics and finance, St. Peter's University. I feel like I should start these videos saying Mike and Pete at this point, but that's fine. That's an inside joke. But yeah, so we're going to be looking at the cash chapter, the internal control, fraud analysis, petty cash, bank reconciliation, your books, the bank's books, a lot of interesting things. So let's get to that. And we're on Easter vacation these next couple of weeks. I have a conference I have to go to, so we're going to be using these videos to supplement the classes. So all classes will be on YouTube until we get back into teaching cycle, which is in a few weeks. Okay, for actually this is for the live class and for the online guys too. The online group, this is the fraud, internal control, and cash chapter, and I'm going to be lecturing on it just like you were sitting in class. So let's look at the objectives: define fraud, internal control, principles of internal control activities, application of internal control principles as according to cash receipts, application of internal control principles to cash disbursements, operation of a petty cash fund, control features of a bank account, prepare bank reconciliation, and explain the reporting of cash. Anybody who's worked in any kind of private equity fund or anything in the investment capital management world, which is the umbrella term for everything that happens in New York, that's what you need to know about. Fraud is a dishonest act by an employee that results in a personal benefit to the employee at the cost to the employer. And there's three pieces to it, three elements of the fraud triangle. There's the opportunity to commit it, where there's a workplace environment where people can take advantage. Financial pressure, personal financial pressure. I think I heard somewhere that the guys who work for the Federal Reserve or any kind of federal banking job, if you've got a lot of debt, that sort of works against you. If you've got financial problems and those kinds of things, that doesn't help you in terms of getting those kinds of jobs. I've run across a couple people here and there over the years that work in those places, and I've heard those kinds of things. So certainly, that can change you taking care of your family and kids, and your parents are old or whatever it may be. That can cause that kind of financial pressure can make people do things they maybe otherwise wouldn't do. Rationalizing it, saying you deserve it, and all these types of things. And fortunately, you have somebody with some legal training too. And I'm not just an economics and finance and accounting guy. And looking at this, these are almost the elements. If you ever took criminal law, you know what I'm talking about. What makes up the law, okay, what you have to do to violate a law, kind of a thing. But this is in terms of fraud, and this is how most the organized crime guys and Madoff and all these people. This is how they were caught. And there's a specific legal definition for fraud that isn't contained in these notes, but it's basically using telephones, mail, and wire transfers, and not doing with money what you said you'd be doing, that kind of a thing. Sarbanes-Oxley. I remember when I started teaching in business schools, about a decade ago. This thing was sort of out there for us to teach in the accounting courses. And all publicly traded companies are required to maintain adequate system of internal control. Executives and boards of directors must ensure that these controls are reliable and effective. Independent outside auditors must attest to the adequacy of the internal control system. Companies that fail to are subject to fines, and companies officers can be imprisoned. And there's a public accounting oversight board that exists that obviously establishes auditing standards. How well you keep your books, how well you keep track of what you're doing. Okay, very, very important concept. Internal control consists of all the related methods and measures adopted within an organization to safeguard its assets, enhance the reliability of its accounting records, increase the efficiency of operations, and ensure compliance with laws and regulations. So yeah, all of that. And these are as we're going through these are the answers to a lot of the questions that you're going to be dealing with, the multiple choice questions in the back of the book and those kinds of things. I've learned that 140 or 150 is a good size. 150 might be a little big. 140, but as we're going through this, if your screen, I have a good screen at home, but when I'm at in the school, sometimes some of the screens, the quality varies from classroom to classroom sometimes. But a control environment, a risk assessment, control activities, information communications, monitoring, all those things you need to keep track of. The 6 principles, again, of control activities, and these are all answers to multiple choice questions, exam questions, establishment of responsibility, segregation of duties, documentation procedures, physical controls, independent internal verification, and human resources controls. Okay, and we're going to have a lot of that stuff that we're going to be dealing with. I apologize for that loud noise. Let me lower that a bit. Here we go. Yeah, cash control. Cash is the only asset that's readily convertible into any other type of asset. Cash over and short in an income statement. It's reported as a miscellaneous expense when there's a cash shortfall, as a miscellaneous revenue when there's an overage, kind of a thing. I always think about this as a physical box with $100. That I think that's the example that we're going to use. Where I think it's a $100 petty cash fund or 50 or, and we'll get to. I apologize for these having the answers on the side like this, but I just want to make sure that I'm consistent with what I'm saying to you guys. So we're here with this. So yeah, here we go. Yeah, so here's an example of the over short, and we'll define what this all is. So let's say, well, the textbook had this particular example. Yeah, let's say there was revenue of 6,956, but the cash that you had was 6,946 and 10 cents. Okay, so you're $10.10 different, and let's figure out over and under and all that other stuff. So equals sum alt HHN, gets rid of the fill. Yeah. Okay, so your revenue was 6,956 and 20 cents, but you measured in the box or in the register 6,946 and 10 cents. So it's short. Yeah, so it's a cash shortfall. So what I started doing, I started bolding out what everything was. If it was short or was just, I think that's helping a little bit, just a little bit better. So I'll do it here too, my notes. And it's nice having the notes. And I have to go home after lecturing and class saying, oh, well, I got to fix this, I got to fix that, kind of a thing. This records a cash shortfall. So the revenue is 956, you have 946, and you're $10.10 short. Okay, and that's how you record it. You record on the debit side, but it's a shortage, a cash shortage. Okay, so that's how those things are. And obviously on the other side, like a revenue. So generally, internal control over cash is more effective when companies pay by check rather than cash. One exception is for incidental amounts that are paid out of petty cash. A common way of handling such payments while maintaining satisfactory control is to use petty cash fund to pay relatively small amounts. That could be plane tickets, hotel bills, any kind of travel, printing expenses. I'm thinking of all the things back in the 2010s, all the things we used to do and needed to pay for, mail, that type of thing. So the operation of a petty cash fund, often called the impress system, involves establishing the fund, making payments from the fund, and replenishing the fund. Okay, so whatever this word, I've never recalled hearing an impress system anywhere, but that's fine. And, okay, so you have all that. The two essential steps in establishing a petty cash fund are appointing a petty cash custodian who will be responsible for the fund and determine the size of the fund. Ordinarily, a company expects the amount in the fund to cover anticipated disbursements for a 3 to 4 week period. We're going to fill this in a second, but in class, I've been playing this, and let's see if we can find it here. It would be Investopedia Custodian, a good video. Let's see if we have this. Yeah. And a financial that holds customer securities for safekeeping. And actually, we're going to play the video in a second. A custodian is a financial institution that holds customer securities for safekeeping in order to minimize the risk of their theft or loss. Holds securities of other assets in electronic or physical form. Since they're responsible for the safety of the assets, the securities may be worth hundreds of millions of dollars, even billions of dollars. Custodians generally tend to be large and reputable firms, is sometimes referred to as a custodian. Bank holds customer securities for safekeeping in order theft or loss theft or loss. A custodian holds securities and other assets in electronic or physical form, and since they're responsible for the safety of the assets and securities, they may be worth hundreds of millions. Custodians generally tend to be large, reputable firms. Fine. Okay, so we have all that. Some special considerations and examples, and there's always some ads at the bottom, so I apologize for the ads. JP Morgan Chase, State Street, Citigroup, and then Bank of China, the Switzerland folks, Germany, a bank in England, France, those types of guys are sort of out there. If investment advisor is responsible for customer funds, the advisor must follow the custody rules set forth by the SEC. The person entity must be considered a qualified custodian, limiting the options to banks, registered brokers, registered dealers, other individuals or entities. Notices must be supplied to custodians when certain activities are conducted on their behalf or using their assets. Further account statements must be supplied to the customers to keep them abreast of the current holdings associated with their assets. If an account beneficiary is a minor, custodian is required due to the rules and regulations limiting the activities of minors, resulting in the creation of a custodian account. Custodial account has the authority to make contributions, investment decisions regarding the assets in the account, and but the funds are ultimately intended to be used by the named beneficiary. And each account can only have one beneficiary, the minor account holder, one custodian, a designated adult representative. The custodian remain in place until he resigns or becomes incapacitated. The beneficiary reaches the age of legal adulthood or with consent. Other people can contribute towards the minor's account, but they have no authority over how the funds are managed or how they're deposited. How it works: in addition to holding securities for safekeeping, custodian must also offer for services such as account administration, transaction settlement, collection of dividends, interest payments, tax support, foreign exchange. The fees charged by custodians vary depending on the services that the client desires. Many firms charge quarterly custodial fees that are based on the aggregate value of the holdings. Because may also have the right to assert possession over the assets if required, often in conjunction with power of attorney. This allows a custodian to perform activities in the client's name, make payments, change investments. Okay, so yeah, that's what a custodian is. And there's a video here, and actually we're gonna play the video very quickly.
Blockchain is transforming entire industry.
That's an ad. I don't really care about the ad.
Custodian is a financial term that describes an institution, usually a specialized bank, which holds customer securities for safekeeping. This prevents the theft or loss of the securities, but it also has a more practical purpose. Due to the volume of financial securities traded on the various markets, it is virtually impossible to keep track of the owners of every security traded on every market. Custodians ease this burden by holding the securities in their own name, but on behalf of the real owners. In this way, the custodian acts as a fiduciary for the original owner. In addition to holding the securities, the custodian also performs other securities-related services, such as dividend and interest payment collection and distribution, transaction settlement processing, tax support, foreign exchange, and brokerage account administration. Custodians charge fees for their services based on the customer's service requirements and the value of the securities it holds on behalf of the customer. The amount of securities held by custodians runs into the hundreds of billions, and any one custodian may hold millions or even billions of dollars in securities. This is a significant responsibility performed by reputable firms such as J.P. Morgan Chase, Citigroup, and the Bank of New York Mellon.
Yeah, folks, I have to put the custodian definitions in there, the power of attorney definitions in there. I think that's useful to throw those definitions in. Pardon me. Yeah, I think it's useful to throw the custodian definition in, the financial institution definition in, the power of attorney definition, to throw all those things in there as we go along. I think that's rather useful to do that. Okay, these are the journal entries. Okay, now what you're doing is you're taking $100, $100 out of cash, and you're putting it in the petty cash fund. And actually, the reason this is black font is it's equal to the debit on the petty cash side. Okay, and this is 150. Okay, so we have all that. We increased it, replenished it, all that. Okay, it means advance of money for designated purposes. Fine. Okay, but that's generally how this, from a journal perspective, how this starts. That's relatively simple. Now we're going to go through 3 examples here. And again, just picture in your mind, almost like when you go to church and they put the money in the it's a wicker basket. It's not a hat or a dish or anything like that. On television, you hear those kinds of things. But the churches, all the churches I go to, it's all wicker baskets. I don't know any church that doesn't have a similar. It's not a box. It's not a dish or a hat. It's none of those kinds of things. So here you have 3 sets of bills, or 3 expenses rather. $44 of postage expense, $38 in freight out expense, which is if you're a supplier and you're mailing something out to somebody, you're incurring the expense. Like if Amazon paid for the shipping, basically, is what that is. I always use the Amazon examples in class. That seems to resonate with people a lot. Okay, so yeah, so what's happening here is, yeah, there's $100 petty cash fund. There's 13 in petty cash. There's 87 more. Yeah, so you have to, what you have to do is you have to replenish it with $87 is what you need to do. Italics, change the font, and make this $sign and knock it down a notch, just because this is a check. So your expenses add up to $87. So what you do over here is say equal sum. That's not always going to be true. Okay, this is something where everything balances. The records of expenses, the physical record of the cash in this theoretical box, everything balances. 87's been spent. There's 87 receipts, and there's $13 left, and you need 87 more to put it back in there. But here's some other examples as we're going through this. This is the same set of expenses is what this is. We'll just copy these, postage, freight out, all that other stuff. All right. And what happened here, and it's very similar to what we had up here. You had the short. Yeah. So this is going to be the short version of this. And let's again think about short and overage, and you want to think about. And this is real. It's as real as it gets. This kind of thing. There's an extra $1 floating around in here. Right, is what this is. Okay, we have an extra $1 here. Let's see the check. How do we do the check? The check was, actually the check, we did the math here, equals 100 minus 12. It was 88. So what we have here, and actually what I'm going to do, we want to add up the bills too. So equals sum. Yeah, you still have $87 in bills or expenses, but you're looking at what you have here, you're asking for 88. So somehow an extra $1 was spent, or an extra $1 was given to one of these three. So somebody got maybe 45 or 39 or 6, or someone took it, right? Is another way to. So this is how the audit function works in banks, where they figure out, this is how the FBI works, and Department of Justice, and all these kinds of organizations, the IRS, where they figure out when there's something wrong, when physically what's in an account versus what the records say are different, or your records are different. And this is the training for that, training for the audit function, which is what we do here. So what we're going to do now is we're going to take this, and I want to make sure that's how I did it here. Yeah. Yeah, 100 petty cash, 12 means 88 more. Yeah, 88 more is needed, but the expenses are really 87. So somehow it's short $1 somehow, and that's got to be figured out what happened. Okay. Like this is just the summation formula. You added them up, and again, debit, credit, debit left, credit right, and over the date and the journal entry and what it is, and all that. Okay, so this is really what's when you have a short situation. The bills are 87 here, so it's somehow short of $1, and you got to figure out, you got to track down what happened with that. Now, this other there's the mirror opposite of that is when you have the same three sets of expenses, but you're over somehow, and let's figure out what that means. Okay, let's bold this out so we know what we're talking about. And it's still $1, I think. That we're still dealing with $1. Okay, so this is 1, which is right there. Okay. And yeah, this is just the math. This is just equal 100 minus. Yeah. Now you look in the box. There's 14 in cash, but your bills or your expenses again are the same 87. Okay. But you look, there's yeah, so the bills are 87, but you're asking for only 86 more, not 88, not 87. So that means somebody here got shortchanged. A bill wasn't paid. There was somebody that either 43 or 37 or 4 or something along those lines. Okay, so that all needs to be figured out and what happened. Okay, and this is just the sum of all this. Okay, is that. right, so there's your 86 in there. And looking at what you did, 100 in petty cash fund, you looked in there, there's $14, there should be 13. So there's an extra buck in there somehow. It's not short, it's over. But again, what's over? The amounts in the box or a dollar over. Up here, there was a dollar short, right? Because if you're asking for 88 type of a thing, but you only spent 87, so an extra dollar is left there. So there should be 13, but there's only 12. Okay, that's how it's short. And here it's over because there's an extra one, and you look at that as the top of the notes as a revenue, which makes sense because the revenue on the credit side goes into the. So again, so if you learn that, I say it many times. If you learn chapter 3 in the accounting book, you know a lot of things. Like I've said that a lot, but that's what that is. Okay. And this is just you're taking this narrative and journalizing is what you're doing. That's really what you're doing here. So in this situation, you're going to say you're going to start the petty cash with 50. You did that. You had some, it says it up here. You had expense 14, expense 10, 15. Okay. And somehow there was cash over. In class, we had a bit of an issue with this, understanding this in class. I want to make sure we go over this. We're a dollar over, so yeah. So again, let's always check our expenses here and make sure that we know what our expenses are. So this is, yeah, you had 39 in expenses. So you had $50 petty cash fund, 39 in and let's get rid of all this gray and get rid of that. And it says you're asking for $50. Okay. And yeah, the fund had 12 in cash. So you're asking for 38 is what you're doing. So we do the math on this. That's that math. This is this. Yeah, this is here. So here equals 50 minus 12 is 38 right there. So yeah, but the bills were 39. Okay. So, or the expenses were $39, right? If you look at this, this is 14, 10, 15. That's $39 in expenses. You're asking for 38 somehow. So you missed covering it by $1. So somebody got shorted here. There's something missing. So you have the box is too much for these people. It's short for them, but for the box it's over. And again, if you look at the movie Casino, there's various parts there where they show the casino money and there's actual boxes of money because there's just so much money that goes into those casinos. And that's sort of how that all happened. So you're here with this. So yeah, there's $39 in expenses. You're asking for 38 to replenish it. So somehow it's short all that. So it's all that. I'm a negative here. There's right there. That's 38. Okay. So yeah, there's an over. Or there's a dollar extra in the box. Okay. So always keep that in mind. Sort of how we deal with this. Yeah, I'm just making sure that I'm just going through all this again. I'm just making sure that my annotation is consistent. Yeah, I have the master file here. So rarely in class, if we say, hey, we got to change this, we got to change that. And, I'm not going to remember from 3 o'clock in the afternoon, to go home and fix it. So, yeah. Okay, we got everything labeled and changed as it should be changed and save all the changes as we go. For the day folks, you have this, and for the online section, I gotta put these notes in your file as I sort of get to the end of this. I gotta put the notes in for you guys just so you guys can see it. Oops, I didn't mean to do that. Apologies. Yeah, see with you guys, you have all the online class, you have the questions here, but you don't have anything else. So yeah, we're at the end, we're gonna drop it in there for you so you guys can have this also. But like I said, let's fill this up and then we can drop the rest in as we go. So okay, so we looked at that. Journal entries of petty cash. Yeah, okay, so we got to that. We did all those. So I think we'll have the whole lecture done, I think, in the one video, and then we'll come back. We'll do we'll do the self-test. We'll do some of those things. So checks, there's a maker. The person who issues the check is the maker. The bank or the payer which the check is drawn. So the maker of the drawer, the person who issues the check, a business, that's a non-bank business. Then the bank, who actually is the payer, and the payee, who's written to. So all of your paychecks, you're the payee. So if you work for Home Depot or Lowe's or Dunkin' Donuts or Wendy's, the payee is you. The maker is Wendy's, and the bank is whatever bank they use. If they use Wells Fargo, for example. Okay, a check is a negotiable instrument that one party can transfer to another party by endorsement. A bank statement shows the depositor's bank transactions and balances. Each month, the depositor receives a statement from the bank. The illustration in the text represents a typical bank statement. There's checks paid and other debits that reduce the balance. Now, you have to think about this. You have to think about this, and I'll find the, let me find the original capital T account. You guys just bear with me while I do that. Down here somewhere. Yeah, there's owner's capital. And notice on the, you should have this, it's just the capital account. Money that comes into the capital account comes in by credit side. Okay? So that's what we're looking at. So debit, the money comes out, like drawing, the money comes out, and the credit goes in. And actually what I'll do, I'll just pick these up and we'll just drop them in our template somehow. Yeah, I could move these over a bit. That's right. Under reporting cash or something. Yeah, there it is. These are just examples. Maybe a little bigger. And this could be whatever, 5,000. Doesn't need to be 10,000. Actually, this should equal that. I can tell I did this a while ago. I wasn't using these equal signs all the time. But this is how banking account works. So it goes in as a credit, money comes out as a debit. Okay, and this is just examples. Emergence center. Okay, it's just that. There you go. Okay. So checks paid, reducing the balance, debit, deposits, other credits, increase the balance, credit. Okay. So you take this back to your early, my early courses in teaching accounting. Just keep that in mind, how that works. Okay. It's obviously very important. Okay. Yeah, let's get the answer sort of to the side there. There, cash fraud, all that stuff. So we're right here with this. Yeah, so yeah, if we need answers for something, we have it. We have our master file there. So yeah, through partial check, bank transactions, how these work, the account balance after each day's transactions, which is that. Okay. So hey, I had the girl asked me the other day, so, oh, do you want your account balance? I said, no, I check it online. I was a little mad at her. But for taking my time, I rush around when I do the bank stuff in Belleville, pay the property taxes, do a lot of different things. So I want to get out my day. Debit memorandum, credit memorandum. Some banks charge a monthly fee for their services. Now, again, expense, debit, right? You're looking right here, owner's drawings, which is right on the side here. See how that works? Debt comes out. They charge fee, a monthly balance, maybe falls below a specified number, or there's some other kind of fee that wire transfers or something, some reason that you're transferring money or using the bank services. They're going to charge you for those. Send statement with the debit memorandum. Explain the charge noted on the statement. Other debit memorandum may also be issued for other bank services. I've never paid for printing a check, but maybe if you get a specialized check or something, you have big ones or something like that, or whatever. There's maybe a specialized version of that, but just the standard checking accounts, I don't think that many people are getting charged for checking. The market sort of determine that. Traveler's checks, I've never used traveler's checks. Wiring funds, sure, I've done plenty of that. Another debit memorandum for charges. If there's an insufficient fund, there might be a charge. If you write a check and ask the bank to honor it, and then there wasn't enough money in the account, there's not sufficient funds or insufficient funds. And I think we'll have a lot of experience with that in some of our past ventures. And again, another inside joke. But yeah, credit memorandum. Sometimes the depositor asks the bank to collect its notes receivable. So again, credit money comes in. Now, I don't recall ever asking my bank to collect my debts for me, but I guess some banks provide that service. And again, even with attorneys, everything's so specialized, and lawsuits and criminal law and civil law, and there's law firms that just do appeals, and things become very specialized. Well, I guess that's good, right? Even the automotive industry, your transmission is generally not going to be the if you need a new transmission or transmission repaired, unless you have a really good mechanic, it's going to be a special place that just concentrates on transmissions that does that work. So, yeah, so a bank will credit the depositor's account for the cash received with the note. This is illustrated by the symbol. Yeah, now you can sell your receivables too, and there's a fee for that, but that's another chapter. We're using Laird Company. This is our example for the chapter. Okay, their bank statement. The bank issuance sends with the statement of credit memorandum to explain the entry. That many banks also offer interest on checking accounts. The interest earned may be indicated on the bank statement. Credit memorandum, interest. Okay, all that. So this is our first example. Yeah, we worked this in class. Yeah, we're almost getting to the end of the section here. We worked this in class. Deposits in transit, you should know, what that is. If you have deposits headed, inbound into your account, you should understand, what that is and how much that is, that kind of thing. So for this particular example, so this is Laird, has customers, hence receivables. Put a little note in there for myself. Laird Company, which is in there. Their bank balance is $15,907, April 30th, for this company that uses Wells Fargo or uses Chase Manhattan or something like that. The book balance is $11,589. That's their book balance. And there's a couple reconciliation steps here that we're going to go through. But the deposits in transit, $2,201.40. Okay. And then you have some outstanding checks here. Okay. I think we added them up and we got $5,904. Yeah, $5,904. But also, I did the math, which again, I think it's better that the more of this that you can do, folks. If you take the CPA exam or you take those exams, they're not, you have to do the math. That you can't bring a Bloomberg terminal with you. You can't bring a consultant with you. All right, so yeah, we just sum them up with commas. So there were 3 checks that were outstanding that we wrote. Okay, and the either maybe in transit somehow, or else it says outstanding checks, that kind of a thing. All right, Laird wrote a check for now. Here's actually, it's fun. I was in the I forget where I was. I was in a bank somewhere. I was maybe in my personal bank or something, and they were dealing with something like this where someone had reversed some numbers. Where Laird wrote a check for $1,226, and the bank correctly paid that amount, but Laird recorded on their books as $1,262. There's about a $36 difference in the check. Okay, so the company on their books said they paid out $36 more than they should have. So they need to subtract that. And let's do them. And again, anytime you have these kinds of mistakes, You need to figure out why and what's going on and that kind of a thing. Right? So that's what that is. Okay, 36 was recorded as being paid out when it really wasn't. That kind of a thing. Oh, yeah. So there was not sufficient funds. So these guys wrote an inbound check to Laird at their bank, and this number was $425.60, and apparently J.R. Barron couldn't cover it. Their account couldn't transfer them because it didn't have it. So apparently this was probably credited, and then you have to debit that, take it out, because what didn't really there wasn't sufficient funds to cover from the origin bank. Okay, there could have been a debit charge here, or for whatever checks or something. And there's the whole credit collection step, which we went over in class. Again, for the online folks, obviously this is the first time you're hearing about this. So it's 1,035. All right, so and I'll show you how that happens. So the bank is crediting this because it goes into your account. Again, always remember what we have here, right? So when the money capital comes in, goes credit, expenses or fees paid out debit. Okay. This one, it's a $1,000 note receivable, which means 1,000 here. There's interest earned. So if I lend money, I lent some $1,000 and they had paid me $50 interest, and then the bank had a fee for collecting that amount, that money was owed. There's a bunch of symbols here: credit memo, debit memo, error collection, interest earned, not sufficient funds, all those types of things. You have all that. Okay, you have a bunch of symbols. Okay, so here's the journal entry. This records a collection of note receivable by a bank on behalf of Laird. So we're showing you how this happens. So the note receivable credit that goes into the bank account, the $50 of interest goes in. There's an expense to the bank for going through the details for you. So equals 1,000 plus the 50 minus, which is all there. This was a situation where this was at $36 that Laird, their books recorded 36 more than, was it their error in recording the check? So they wrote a check for one, the bank paid it correctly, but Laird, yeah, they recorded it as, yeah, so that's go in, yeah, correct. So, right, debit 36, sure. Now your payable goes down by that amount, okay? So we just say equals this 36 up here. There it is, the math that we did up there. So it's linked to it. So in class, I can remember it because the journal entry was you recorded $36 more went out on a check that didn't need to go out. And the payable, you also probably wrote the payable down to the destination, which is Andrea Company, funny enough. And so you had to re-credit their payable where they owed you another 36 because you probably wrote it down, but you debited it too much by $36 too much. Okay. Receivable here, yeah. So what that check, you're owed $425.60. So you're writing it like this. That's a receivable now. The person, J.R. Barron, still owes you, but it's not cash. It's a receivable. To record the not sufficient funds check. Then you have a miscellaneous expense. This is just your standard debit situation. It comes out of cash. Okay. Record charge for the checks. Fine. Okay, look at that. All right. Your books, say 11,589. Okay. 11,589 and 45 cents. Okay, so we'll write that down. 11,589 and 45 equals this. All right. and now debit. And yeah, and now you got to sort of switch gears a little bit. You're the ledger now, so cash that comes in is at 1,035 is right here. So it comes debit is cash, which is right there. The 36 comes in right there. Credit 425, and then credit the 30. Okay. There you go. 12,204. Now that number is not the bank's number nor your number, but they have to balance up, because if you see here, the bank shows on April 30th 15,907, and it's neither one of those. The 12,204 is neither one. So, but they, after doing all this, bank's numbers and the book's numbers have to be the same. That's the point of what we're doing here. Okay, so now you're looking at the bank's numbers and how the bank looks at everything here. So the bank's numbers are 15,907. This is the audit function, folks. 45 cents. Deposit in transit 2,201 and 40 cents. All right, you're going to sum these. All right, use the sum function in Excel. All right, and all that. Then you have a couple checks here, and you got a list of these things: 3,000 and 401 and 30 cents, 1,502 and 70 cents equals sum. That 5,904. This equals this plus that. Okay. And 20,000. I'm sorry. How could it be that? It's, oh, pardon me. This has got to be subtraction. Yeah, we made a mistake there. Even myself, I got to be very careful with this. This is negative. Yeah, those are the outstanding checks. So here, let's look at why that is. This is the cash balance for the bank statement. You know you have 2,201.40 inbound, and then you wrote $5,904 in checks, which have to come out. And that's why it's 12,204. Okay. Next piece of this is your books say 11,589.45. Okay. You had an error, $36 error in recording the check. You had this 1,035, right? Or you could sit and do it yourself. 1,000 plus 50 minus 15, you know, that kind of a thing. You could do all the math yourselves. Yeah, with the math is done up there. Okay, this equals sum parenthesis this comma 1,035. Right, and so anyway, think what you're adding up here. Cash back again. It's got to be cash. So this is all the 36 is inbound. The 1,035 is inbound. So you're adding all these things here. It's $12,666.45. This is 425.60, 0, 30 equals sum parenthesis. Just add up all these. So you're taking out the not sufficient funds check. You're taking out a service charge, and the drum roll is this number minus this number. Yeah, they're both 12,204. See, they match. Okay, that's a reconciled bank account, a reconciled book account. That all the reconciling items that cause the difference between the two balances: deposit in transit, outstanding checks, errors, bank memoranda. Deposits in transit are recorded as by the bank deposit, not been recorded by the bank. Issued checks recorded by the company, not paid by the bank or outstanding checks. Adjusted cash balances in the ledger should agree. Okay, with the adjusted cash balance for books. You have electronic transfer funds, right? Among parties that use of paper, right? ETFs, disbursement systems, wire, telephone, computers, a lot of these kinds of things. Yeah, bank reconciliation, owns a fabric store, how to reconcile the following, how to reconcile these items in the bank. So a debit memorandum for a not sufficient funds check, deduct balance from the books, right? Because the bank initially had counted that as a debit for cash, but a credit on your capital account, but you have to deduct it from the books. A note collected by the bank, add to the balance per books. So the first two are books, collection of the note. Outstanding checks, deduct from the balance per bank. Deposits in transit, add to the balance per bank. Okay, so it's telling you how to, if you're having some of these situations or having some of these transactions or circumstances, how to account for it, which is the whole point of what we're doing with you guys, teaching these things. Okay, let's save all that. Let's just fix a couple of these as we go. Okay, there's your template. Okay, we did a problem in the reconciling items. Okay, and now this is the reporting cash piece. I think we already gave this example. Actually, what I probably should do, I didn't do it here. I don't think, and I should. This is, just take this example here, copy. Yeah, this is, again, it's great when you have your master file right next to you. Okay, so yeah, so this is restricted cash. If there's lawsuits or equivalents, how, what a cash equivalent is. But that's how the cash flow statements are created with the balance sheet cash entries, and actually those need to match. The cash on the balance sheet and the end of the year cash, those need to be the same number. And the CFA group learned that last cycle. Something to keep in mind. Okay, but yeah, there we go. Okay. Yeah, now this is another problem here, and actually, I'll do a part 2 to these lectures, to the cash lecture. But this is probably a good place to put a pin in it, because this is just the same kind of a problem. But we'll do it again, and we have some of these questions here, which will also review the idea. So yeah, let's put a pin in it at this point, and yeah, I'll post this video, and you'll have something on this, and then we'll continue this. We'll have the comprehensive problem, we'll have some of the self-tests, and you guys will be ready to go with this. But there's your lecture on cash. Okay. I'm just saving everything, just making sure I save my changes. I got to post everything now and all that, and I'll do that all for you guys. And actually, as we're just talking here, maybe you can see how to move big pieces of notes here. This is the online group, and let me pick off the template here for you guys. Yeah, so we just did this. So we're going to go all the way across. Right. This is, yeah, some prep review. I don't know, a couple hundred lines. Down, yeah, nothing cut off. Copy. I did have that issue. We cut something off once. I wasn't happy about that, but oh well. And paste. There you go. So now the online folks have the cash notes also, and we'll post all that. I always like to put a little red bar by things if there's something we didn't work on or didn't do. And so, yeah, this is you guys. This is you guys. This is you guys. Okay, yeah, so what I'll do, I'll put a red bar like that. So next, it can even be later on tonight. But this is part 1. And then we'll hit this problem, we'll hit the self-test. Okay, we'll sort of do this all again and just get more. But that's good for another video, because I don't want to just repeat myself. So, okay, let me save this. So yeah, the online guys are good. My notes are good. The template is good for the live guys, or the live section. You guys have your template here. We'll post this. Okay, and that's it. We have the accounting. So yeah, we're good. Okay, folks, again, it was good talking about the cash lecture with you guys. I think it was about an hour tonight or so, and we'll do part 2. We'll do the comprehensive problem. We'll do some of the questions, and you'll have everything you need for the cash. Okay, for the cash lectures. Okay, folks, enjoy the holiday weekend. Like I said, be on the lookout for the second lecture on cash.